The year is 1971. Richard Nixon, the US president, makes a seismic decision. He ends the Bretton Woods system. This system, in place since World War II, tied the value of the US dollar to gold. With Nixon's announcement, that link is broken. Global currencies are set adrift. A new era begins, one where interest rates take center stage. Before 1971, interest rates played a supporting role in global finance. They were a factor, yes, but not the main event. After 1971, everything changes. Interest rates become the primary tool for central banks to manage their economies. They become a lever used to control inflation, stimulate growth, and stabilize currencies. This shift unleashes a wave of innovation in financial markets. New instruments, known as interest rate derivatives, are created. These derivatives allow investors to bet on the future direction of interest rates. They also provide ways to manage the risks associated with fluctuating rates. The financial world is becoming more complex, more interconnected, and more reliant on interest rates than ever before. The 1990s arrive. The Berlin Wall has fallen, the internet is gaining traction. Amidst these geopolitical and technological shifts, another revolution is brewing: financial engineering. Wall Street embraces complex financial models, using them to create new investment products. Interest rates are at the heart of this revolution. Securitization, the process of bundling loans into tradable securities, explodes in popularity. Mortgage-backed securities, many linked to interest rates, become a cornerstone of the financial system. Interest rate swaps, contracts that allow parties to exchange interest rate payments, proliferate. The global derivatives market, fueled by these interest rate products, balloons to an unfathomable size. By 2008, it's estimated to be worth over $600 trillion. This interconnected web of financial instruments, built on a foundation of interest rates, becomes a source of both immense profits and hidden risks. The stage is set for a reckoning. The year 2008. The global financial system teeters on the brink. The collapse of the US housing market triggers a chain reaction, exposing the fragility of the financial engineering edifice. Central banks around the world take unprecedented actions. They slash interest rates to near zero, hoping to stave off a complete economic meltdown, the zero lower bound. It's a concept that most people never thought about, let alone experienced. Now it's a reality. Central banks, accustomed to using interest rate cuts as their primary tool, find themselves pushing against a wall. They need new ways to stimulate their economies. Negative interest rates, once considered an economic anomaly, become a policy tool. In some countries, depositors are charged a fee for holding money in banks. The world of finance, built on the assumption of positive interest rates, is turned upside down. The era of easy money, characterized by low interest rates and readily available credit, comes to an end. The search for a new equilibrium begins. The future of interest rates is uncertain, but one thing is clear: change is coming. Technology, always a disruptive force, is poised to reshape the landscape of finance. Tokenization, the process of representing assets digitally on a blockchain, has the potential to revolutionize how interest-bearing instruments are traded and managed. Artificial intelligence and machine learning are also playing an increasingly prominent role. Algorithms are being used to analyze vast amounts of data, identifying patterns and making predictions about future interest rate movements. This data-driven approach is leading to more dynamic and responsive interest rate setting. Decentralized finance, or DeFi, is another trend to watch. Built on blockchain technology, DeFi platforms offer alternative lending and borrowing mechanisms, bypassing traditional financial institutions. These platforms have the potential to democratize access to financial services, but also introduce new risks and challenges. The future of interest rates is likely to be shaped by a confluence of factors: technological innovation, evolving monetary policy, and the growing importance of social and environmental considerations. Understanding these trends will be crucial for navigating the complex and evolving world of global finance.